Technical indicators are the interpreters of the stock and CFD markets. They look at price information and translate it into simple, easy-to-read signals that can help you determine when to buy and when to sell a stock or CFD. Technical indicators are based on mathematical equations that produce a value that is then plotted on your chart. Each technical indicator provides unique information. You will find you will naturally gravitate toward specific technical indicators based on your trading personality, but it is important to become familiar with all of the technical indicators at your disposal. You should also be aware of the one weakness associated with technical indicators. Because technical indicators look at historical price data, they do lag current market data to an extent, but they still provide excellent information. Technical indicators are divided into three categories: trending indicators, oscillating indicators, and volume indicators. Let's start by looking at trending indicators. Trending indicators, like moving averages and Bollinger Bands, identify and follow the trend of a stock or CFD. Learning to interpret trending indicators can help improve your trading results because stock and CFD traders make most of their money when stocks and CFDs are trending. The first and most basic trending indicator is the moving average. Moving averages show you what direction a stock or CFD is going and where potential levels of support and resistance may be. Moving averages themselves can serve as both support and resistance. Moving averages are constructed by finding the average closing price of a stock or CFD at any given time and then plotting these points on a price chart. The result gives you a smooth line that follows the price movement of the stock or CFD. The next trending indicator is Bollinger Bands. Bollinger Bands can show you not only what direction a stock or CFD is going, but also how volatile the price movement of the stock or CFD is. Bollinger Bands consist of two bands, an upper band and a lower band, and a moving average, and are generally plotted on top of the price movement of a chart. Bollinger Bands are typically based on a 20-period moving average. This moving average runs through the middle of the two bands. The upper band is plotted 2 standard deviations above the 20-period moving average. The lower band is plotted 2 standard deviations below the 20-period moving average. A standard deviation is a statistical term that measures how far various closing prices diverge from the average closing price. Therefore, 20-period Bollinger Bands tell you how wide or volatile the range of closing prices has been during the past 20 periods. The more volatile the stock or CFD, the wider the bands will be. The less volatile the stock or CFD, the narrower the bands will be. Let's now take a look at oscillating indicators. Oscillating indicators, like the Commodity Channel Index, or CCI, the Moving Average Convergence Divergence, or MACD, and the Slow Stochastic and Relative Strength Index, or RSI, are indicators that move back and forth as stocks and CFDs rise and fall. Oscillating indicators can help you determine how strong the current trend of a stock or CFD is and when that trend is in danger of losing momentum and turning around. While each oscillating indicator has a unique calculation, all oscillating indicators provide similar information. When an oscillating indicator moves too high, the stock or CFD is considered to be overbought. Too many people have bought the stock or CFD, and there are not enough buyers left in the market to push the stock or CFD higher. This indicates the stock or CFD is at risk of losing momentum and turning around to move lower or sideways. When an oscillating indicator moves too low, the stock or CFD is considered to be oversold. Too many people have sold the stock or CFD, and there are not enough sellers left in the market to push the stock or CFD lower. This indicates the stock or CFD is at risk of losing momentum and turning around to move higher or sideways. You can see, looking at charts containing the Commodity Channel Index, or CCI, the Moving Average Convergence Divergence, or MACD, the Slow Stochastic, or the Relative Strength Index, or RSI, that the oscillating indicators move up and down and up and down. Typically, you want to buy as these oscillating indicators turn around and start moving up off of their lows, and you want to sell as these oscillating indicators turn around and start moving down off of their highs. Of course, it will take some practice to learn how to identify these highs and lows, and they don't work every time, but you can put the odds in your favor as you trade using these oscillating indicators. Let's look now at volume indicators. Volume indicators provide incredible diversification to your technical indicator portfolio because instead of relying solely on the price action of a stock or CFD in their calculations, they take a completely different piece of information into the equation, which is volume. Price action can tell you which direction a stock or CFD is moving, but volume can tell you what kind of support is behind that price action. Both on-balance volume and accumulation distribution can show you when the stock price movement is supported by increasing volume, which usually results in a continuation of the trend of the stock or CFD. They can also show you when the stock price movement is not supported by increasing volume, which usually results in a trend reversal for the stock or CFD. When the on-balance volume and accumulation distribution lines are moving higher, you know there is increasing support for the price movement you are seeing on your charts. Trading in the stock and CFD markets is all about obtaining and accurately processing the best information you have available to you. Technical indicators can help you do just that.